Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
We are going to turn our attention to what happens and what you should prepare for after a spouse passes away.
When you turn 16, you can drive, and when you turn 21, you can go out for drinks with friends. But 65 is perhaps your most momentous birthday of all. Is it better to rent or to own if you're retired?
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Cole and Ryan from Buska Retirement Solutions and Buska Wealth Management. We're going to go through some questions about how to plan for retirement. But before we do, if you are interested in having one of your questions answered on a future segment, please email us at info@retirewithbuska.com. Ryan, Cole, thank you so much for joining me today.
Thank you.
We are going to turn our attention to what happens and what you should prepare for after a spouse passes away.
Sure.
So, Cole, I'm going to start with you. Why should I try to avoid big life-changing decisions after a spouse passes away?
Well, I think the biggest thing to remember is that you're grieving, and in the time of grieving is not necessarily the best time to be making big decisions, especially big financial decisions. Sometimes those decisions can be swayed by emotion, and obviously emotional decision making is something that we as financial professionals are always trying to help our clients to avoid. And I think that is easier when you have a financial professional that you trust, that you've worked with, that you can really rely on to provide you the necessary guidance to make more well-informed decisions. Now, that doesn't necessarily mean that you can't be making any decisions after a spouse passes away. Obviously, there are decisions that have to be made, and sometimes in a timely manner. But I think that's one of the important components of finding that trusted relationship with a financial professional is you have someone that you know you can turn to, that you've placed your trust in, that has demonstrated you can trust them, and is going to provide you that well-rounded guidance so that you can avoid that emotional component of the decision making. Obviously, we're still going to have those emotions. We're still going to be grieving through that process. But if we can go through it with someone that can try to set that emotion aside and look at things from, a facts and a real, kind of based in knowledge approach versus based in emotion, I think that can really help to simplify the process, make it easier to be making very good decisions for yourself, and also having some plans in place well in advance. Certainly working with a professional, they can look at what are the implications if someone passes away unexpectedly, what are some of the things we might need to do. So there might already be a foundation of a plan in place, and so we can just help direct our attention back to the work that we've done in advance so that it makes that process a little bit easier for that grieving spouse.
Yeah. And Ryan, I might be entitled to some benefits after a spouse passes away. How can I find out whether or not I am entitled to a survivor benefit?
So it can depend on exactly what type of benefits we're talking about. For example, if your spouse has had a pension, when they made that pension decision, they had to make survivorship benefit choices. That might mean you are entitled to the full benefit that they were receiving. You might be entitled to 75%, 50%, or nothing. And that will depend on the choices that hopefully you as a couple made, but perhaps they may have made on their own. Right. So in order to do that, number one, that should be hopefully something that you know ahead of time, or something that you maybe spoke with your financial professional about and they may have record of notes on. So when you go through that process, you'll need to contact, if it's a pension, like that pension provider, and go through the process of death certificate, and every particular company will have their own process. The exact same thing will actually be true if you have something like an income annuity as well, that's providing you your spouse lifetime income. Yeah. You may have elected a survivorship benefit on that as well, keeping, again, 100, 75, 50% of that benefit going on long term. Regarding Social Security, the answer as to whether or not you qualify for a survivorship benefit partially depends on who is getting more out of Social Security. Mm-hmm. If your spouse that passed away was actually receiving less, then there isn't going to be a change. Your benefit will continue to be yours. However, if they passed away and perhaps were receiving the higher benefit, your benefit then is likely to go away, and you will step up to receive what their benefit was monthly until your passing. So to do that, you'll want to contact the Social Security Administration, basically go through a similar process of verifying the spouse's passing, and they will be able to help you with the logistics from there. The biggest thing that you're going to need to remember, regardless of where it's coming from, is you're going to need to contact that particular organization so that they can begin the process, because it is a little bit of a process to get that changed over and to have that acknowledged so that you can continue to receive your maximum benefits going forward.
Yeah. And I think one of the other things to be mindful of is you do probably want to reach out to those institutions right away, especially the pension or Social Security, because of course, if they continue to pay benefits that you're not potentially entitled to, they will potentially pull those payments back, or you'll have to pay them back. So if obviously you're using those for living expenses, you're going to want to suspend those payments right away if they're going to suspend, so that you don't wind up, a few months later having to pay back a big chunk of money that you weren't expecting because you didn't realize that you were no longer entitled to those benefits. So I think it's really important to try to make those communications right away so that you don't wind up in a sticky situation a little later.
Yeah, that's really good to know. And you mentioned death certificates and having to prove that something has happened that entitles you to the survivor benefit. Mm-hmm. Cole, I think this is a question we get often. How many death certificates should I request?
Sure, and that can be a little bit of a loaded question because it depends, and we say that a lot, unfortunately, but when it comes to the number of death certificates that you're going to want, you can begin by counting the number of accounts that you have with various different institutions. If there's multiple accounts with one institution, usually they're only going to need one death certificate for all of the accounts, but at the same time, you might have 3 different banks and 5 different investment companies and maybe a few insurance companies involved. So, a good rule of thumb is maybe start around 10 death certificates. You can always get more later. So if you have to get, a larger number of them, you can always have more produced in the future. And it's always hard to tell because some companies will take a copy of them. Some companies are going to require that original with the stamp, so it ultimately depends on the institution and their rules. And of course, every company is a little different. So there's no way to know for sure, but I would say a comfortable number is maybe start around 10, unless you know for sure you have more or less accounts than that. Then you could start with a different number based on your unique situation. But for somebody that isn't sure, I would say 10 is a good place to start, and then you can always add more later.
Okay, great. Now, in terms of survivor benefits, can accounts have a named beneficiary, and do they avoid probate?
So typically, if you have a beneficiary named, you will avoid probate. That's one of the things we talk about when it comes to making sure all of your financial accounts have either listed beneficiaries, if they're like an investment account, like a 401k, IRA, Roth IRA, or even a non-retirement account. Something like with your bank accounts, you want to make sure you have payable on deaths. Any type of property that you'll have, you want to have some type of transfer on death form. Now that will vary depending on the type of property that it is. And also making sure that even for things like personal property, which may not have clearly laid out beneficiary forms, you're going to serve yourself better by making sure that those items, particularly if they are of material value, to be listed out in something like a will or a trust. But if you have beneficiaries listed, you are going to either avoid probate entirely or at least maximize the probability that you will be able to avoid it.
Absolutely.
Great. Well, thank you both for going through a couple of our questions on what to do after a spouse passes away. And thank you for joining Financially Speaking. We'll be back with more right after this.
Close your eyes and picture retirement for a moment. What does your dream look like? Would your days be filled spending time with family and friends? Maybe you desire to volunteer or work a rewarding part-time job. Or do you envision traveling the world? Whatever your dream consists of, Buska Retirement Solutions can help you realize it. Call or go online to schedule a complimentary consultation today. And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Kaylee Berenson from Buska Retirement Solutions and Buska Wealth Management. Today, I want to talk about what to know when you turn 65. Certain birthdays are particularly momentous. When you turn 16, you can drive, and when you turn 21, you can go out for drinks with friends. But 65 is perhaps your most momentous birthday of all. An AARP article titled 5 Things You Need to Know About Finances When Turning 65 provides some very helpful information. First, let's talk about what 65 means for Social Security. The first thing anyone turning 65 should consider is that milestone doesn't mean you've reached your full Social Security retirement age. Even though retirement advertising can often make it seem like 65 is the be-all and end-all retirement age. When it comes to Social Security, the full retirement age is 66 for those born between 1943 and 1954. From there, it rises in 2-month increments every year until it's capped at 67 for people born in 1967 or later. While you may begin receiving Social Security when you hit 62, your monthly payment will be smaller for the rest of your life, depending on how long before your full retirement age you choose to file. If you were born in 1955, your full retirement age is 66 and 2 months. But if you file for Social Security when you're 65, that's 14 months earlier. Accordingly, your monthly payment would be permanently reduced by 7.82%. You should also note that filing early may shrink the survivor benefits your spouse is eligible for after your passing. Moreover, if you file before your full retirement age and you're still on the job, your monthly payment may be smaller based on your income. And speaking of retirement programs that may be vital for a lot of retirees, age 65 is also when you can enroll in Medicare. If you enrolled in Social Security before you turned 65, you'll automatically be enrolled in Medicare. However, if you turn 65 prior to enrolling in Social Security, you must formally enroll in Medicare. You're afforded a 7-month window to enroll 3 months before you turn 65, your birthday month, and 3 months after that. You're permitted to enroll in Medicare on Social Security's website, even if you aren't prepared to enroll in Social Security itself. There's still much to know and consider when it comes to Medicare's rules and regulations. I'd strongly urge you to talk about Medicare with your financial services professional, and also a financial services professional may be able to assist you enrolling in both Medicare and Social Security. Now let's pivot a little and let's talk about HSA options. Turning 65 also means you can use your health savings account. commonly referred to as an HSA, for additional expenses. Ultimately, an HSA may provide you with a triple tax break. First, your contributions are tax deductible or pre-tax if your HSA is provided by your employer. Second, the money in your HSA grows tax deferred. And third, you may be allowed to withdraw some money tax-free for qualified medical expenses. Perhaps even better, when you turn 65, you may start using your HSA for more expenses than you could before that milestone birthday. While you must stop making HSA contributions while you're enrolled in Medicare Part A or B, the money in your account may keep growing and can be used for certain medical costs in the future. Additionally, you generally must pay taxes and a penalty if you use HSA money for something other than qualified medical expenses. But those penalties disappear when you turn 65, and you must only pay taxes on money that's used for non-medical expenses. Your policy qualifies you for an HSA if your deductible is at least $1,600 for a self-only policy or $3,200 for a family policy. Those are the 2024 numbers, a slight increase from 2023. Before I sign off, I want to talk about how important it is to keep saving. If you're still enjoying your career when you turn 65, even if you're working part-time, you can keep stocking away money, and you can also keep contributing money to your Roth or traditional 401k at any age as long as you're earning some level of income from a job. Thankfully, you have many options for retirement savings shortly before and after you turn 65. So work with a financial services professional to construct a strategy that suits your needs and your goals. If you're turning 65 soon, it may be a great time to sit down with a financial services professional and talk about your next steps. Contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more from Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Sue Buska from Buska Retirement Solutions, and joining me today is my daughter, Kaylee Berenson. Today, Kaylee and I are going to talk about whether you should rent or own your own house when you relocate for retirement.
This is a great topic, and I think many of our viewers can relate to it. According to an AARP article titled "The Relocation Dilemma, to Rent or to Buy is the ultimate question for retirees who move."
And the article notes that the share of baby boomers who are renting is going up.
What do you think, Mom? Is it better to rent or to own if you're retired?
Well, I agree with what the article says, that renting isn't better than owning and vice versa. It depends on your individual circumstances.
I can understand that. And fortunately, the article lays out 6 questions that can help you determine whether you should buy your retirement home or you should rent it.
So Kaylee, what's the first question?
Well, the first question you need to ask yourself is, how are your finances? According to the article, renting is less expensive than taking on a new mortgage.
And that's true. However, if you can make a big enough cash down payment to secure a low mortgage payment, then buying can be a less expensive option. But keep in mind that you might have to pay more up front.
Yeah, and closing costs can be a big expense. Plus, you have to pay for your insurance, property taxes, and maintenance, all things you don't have to be responsible for if you're a renter.
And the downside of renting is that your rent payments can go up considerably each time you sign a new lease.
That's a great point, Mom. And if you're going to be on a fixed income in retirement, you may want to consider whether your budget will be elastic enough to absorb the cost of rental increases.
Well, what's the next question on the list, Kaylee?
Next up, how much do you want to simplify your life?
Well, that's a good one, and we've touched on this a little bit already, but as we age, we may not want to let go of home maintenance tasks, but sometimes our bodies insist that we do.
That is true. Climbing up ladders with arthritis isn't on anybody's to-do list.
Absolutely, and if you opt to rent an apartment or condo, you can hand off all those maintenance tasks to somebody else. If the faucet breaks, just call someone up and let them deal with it while you are relaxing.
That does sound pretty nice. Renting also means somebody else is in charge of the shoveling, the mowing the lawn, and taking care of all that landscaping.
And there is a downside, which is that you can't modify the house to suit your preferences.
That's also a great point. There are also some people who enjoy home improvement projects and they would prefer not to let that go.
And I would also encourage people to make sure that if they do become renters, to ensure that you're moving to a place where the maintenance people are reliable. Sadly, that's not always the case. Now moving on, what's question number 3?
Question 3 is, how clear are your long-term plans?
And that's a great question. If your retirement plan includes moving to a new city, it may be a good idea to rent for a while before you decide which neighborhood best suits your needs.
I like that. Try it before you buy it.
On the other hand, if you've already done your research and you know where you want to be, buying that new house may be the way to go.
All right, and on to question number 4. It's similar to question number 3, and how well do you know your retirement destination?
And the answer to this question is somewhat similar too. Rent for a while to get an idea of where your forever home should be, unless you've already done your research and you're confident about your decision.
Absolutely, Mom. And on to question number 5. How might your physical needs change?
Well, I like this question because aging in place is a goal for many seniors, but staying in your home may require modifications so you can still get around in it.
Another great point, Mom. Grab bars, curbless showers, and entrance ramps can all make your house more accessible so you can continue to enjoy your home that you've built even as you get older and it may be harder to navigate.
Exactly, and it can help make a new home more accessible if you rent. The building management likely won't let you make any of the changes, but if you buy something, a 2-bedroom condo, say, you can do whatever you want to it.
It's also important to keep in mind that there are federal laws that allow you to make changes to your rental for aging in place, but you still have to work it out with your landlord.
That's right, and the landlord could require you to take those things out if you decide to move, and that can be really expensive.
So I think what you're trying to say is, if you know that you'll make modifications, you may want to consider buying. However, if you're renting, you can move to a place that better meets your needs. For example, if you'd rather be in a building with elevators instead of a walk-up, you can pack up with your lease and then ride that elevator to your new home.
What's the last question on the list, Kaylee?
Okay, here's the last question, Mom. Are you willing to wait for your dream home?
Well, there are times when it makes sense to wait, such as times like now when interest rates are high and home inventories are really low.
So it could be a good idea to rent for a while until things ease up a bit. Then you may be able to get the house at a better rate.
Exactly. And on the other hand, if selling your home has left you flush with cash, then why not just go for it?
That's a great point, Mom. And if you can buy outright and you aren't worried about interest rates, and you find the home that you want in the right price range, you may want to jump on that opportunity.
Well, Kaylee, before we sign off, you mentioned interest rates. So let's talk about interest rates. Do you think they're going to go down this year?
Another great question, Mom. According to the Business Insider article titled, "Will Mortgage Rates Go Down in 2024?" the Mortgage Bankers Association predicts that 30-year mortgage rates will dip into the 6.1% to 6.8% range in 2024.
Another interesting tidbit of information is that Fannie Mae originally predicted that interest rates would drop under 6%, but now is saying that they won't go below 6.4%.
Well, higher interest rates are a tough pill to swallow when you're taking out a loan for a house or a car, but are higher interest rates bad for everybody?
Great question, Kaylee. And there are some people who benefit from higher interest rates, for instance, savers.
That's right, Mom. If you've been thinking about putting money in a multi-year CD, it may be a good time to do it while interest rates are higher, according to a CNBC article.
And also keep in mind, higher interest rates are good for annuity buyers too. According to a Smart Asset article entitled Rising Interest Rates Mean Annuities Are Hot.
Great call out, Mom. That article points that with a fixed annuity, you can lock in that higher interest rate for life, even if the Fed lowers interest rates.
Now may be a great time to talk with a financial services professional about choosing an annuity.
I agree. There are many annuity options, and it can be very helpful to have an experienced professional help you determine which product best meets your individual needs.
Well, this conversation has taken a bit of a turn now, hasn't it?
Well, in the end, all these financial matters are a smaller part of a bigger picture, so it makes sense to have them all as part of the discussion.
Well said, Kaylee, and that's all we have for today. If you'd like to discuss the pros and cons of renting or buying or talk about your overall financial strategy, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you ready to make your retirement planning more stress-free? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make securing your future easier. By creating a comprehensive retirement plan that incorporates retirement income solutions, investment management, estate planning, tax strategies, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get that second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.